Hi, welcome to Elite Trend Trader. My name is Frank Bunn. On behalf of everyone here at EliteTrendTrader.com, I'm very excited that you chose to join us on what promises to be an informative and profitable journey in which you are about to learn exactly how to profit from market trends of all kinds. Before we initiate the training, you must first be introduced to several key principles which form the foundation of the system logic. These principles are empirical truths based on over a decade of testing and trial and error. Throughout the training, as you learn the specifics from tape reading to setup triggers, risk control, and trade management, these principles will become more self-evident. The first thing we will examine is the role of randomness in market phases. Proceeding then to an important concept, something that you might be doing which is hijacking your efforts to consistently make money and preventing you from realizing your true best potential as a trader. Next, we'll examine the rule of randomness, a simple empirical truth that will save you years of wasted time and energy. Proceeding to the directional dilemma, the reality of the markets with which you absolutely must be familiar in order to consistently make profitable trades. And finally, we'll introduce you to the key concept of trend trading, the truth of the trend, and conclude with the trading solution that Elite Trend Trader offers as a gateway to lifelong profitability. Let's begin with examining the collective market. The market oscillates between two dominant phases, expansion and contraction. When demand outstrips supply, or vice versa, the buyers will overcome the sellers, resulting in price markup, the expansion phase noted for successive higher and higher prices. The exact opposite occurs when supply outstrips demand and the sellers take control, sending prices to lower lows in the expansion down phase. After a time, in either direction, prices will hit an equilibrium whereby sellers meet buyers and the market consolidates in a contraction phase. Contraction is characterized by range-bound, light volume trading as price oscillates in the consolidation. Following this, some catalyst, either technical or fundamental, will cause price to enter the expansion phase once more. The cycle continues on and on as human fear and greed drive prices from consolidations through extreme highs and lows, cycle in and cycle out. Understanding this true nature of the markets is critical to trend trading, since uptrends and downtrends are hallmarks of expansion. Directional trading requires that prices be moving in order for the trader to profit. With this concept firmly in mind, let's take a look at something you might be doing which is probably hijacking your attempts to achieve consistent profitability. You may very well be disregarding randomness. Everyone sees their own truth in however they analyze market data of any sort and arrive at buy and sell decisions. In essence, every trader trades his or her beliefs about the market. One aspect of screen trading is that traders become prone to creating belief systems that certain outcomes are probable given specific technical and fundamental occurrences in the market. These belief systems often result in outcome dependency. Traders, as a result of disavowing market randomness, condition themselves to believe that the outcome of any trade is entirely dependent on whatever technical or fundamental characteristic triggered the trade. That is to say, the trade setup trigger is responsible for subsequent price movement. As a result, the trader embarks on a quest to create new and improved systems designed to produce better and better perceived results. Meanwhile, the market continues to deceive the trader with random outcomes. The search for the Holy Grail trading system ensues, whereby the trader might remain in system research and development for years, wasting valuable time and energy as the frustration cycle continues on and on. You see, the solution rests in understanding the rule of randomness. I learned this through my own experience with system development as well as interaction with a valuable mentor who showed me the ropes many years ago. Price action, the market itself, following any technical trigger is random and not determined by the technical trigger itself. I'll give this a minute to sink in. Accepting this truth will allow you to end outcome dependency. Indeed, you'll become outcome independent, moving quickly to creating a risk-based trading game, as I'll show you, which is really the only thing you need to achieve lifelong profitability. Let's take it one step further. The trader's greatest challenge then is to manage randomness. Let's face it, system development and trading style is necessary. I learned to manage randomness with what I later called my recurring price pattern principle, which is the concept of separating probable tradable patterns from random price movement. These probable patterns, which occur over and over again, form the basis of what I'm about to teach you, how to take low-risk, high-probability entries with fixed risk and theoretically unlimited reward. The recurring price pattern principle embraces randomness and defers instead to risk and trade management, whereby traders are able to capitalize on the massive winning trades the market will randomly throw their way. This brings us to the directional dilemma. In order for traders to profit from moving price, they must be right or correct about the market entry, how or where and when they enter the market. The trader must also correctly assess adverse price action as constructive or not, whereas prices will encounter its numerous bouts of selling as they move higher throughout expansion cycles. Finally, the trader must correctly forecast a price reversal, or the end of the trend, or at least the point at which contraction is imminently more likely than continued expansion. And the trader must do all of this consistently. That's a tall order. No wonder so few win in this game and so many lose. There is, however, a solution. Let's learn about the truth of the trend. An established trend in price is statistically more likely to continue from one interval to the next than it is to reverse. This is the self-evident rule of trends that we'll use to profit from reversals and continuations. So what is the elite trend trader solution? We assume the truth of the trend and add setups which produce the lowest risk entries possible. Then use a market-neutral strategy to profit from probable direction given all the possibilities of random outcomes. I'll show you exactly how to profit from directional trading as well. The key here is to once and for all end the frustration cycle and get on to lifelong profitability and wealth building. This solution is the promise of Elite Trend Trader. This is a comprehensive method and a complete trading solution which will enable you to trade any market, up, down, or sideways, throughout any expansion and contraction cycle, over and over again and again. As a result, you'll become a professional screen trader capable of profiting from capital appreciation and trading profits in up and down markets, as well as producing monthly income in any market, sideways, up, or down. And that's my promise. When you complete this training, you will have all the tools you'll ever need to create massive wealth from the financial markets through the development of your own style and presence. Excited? You should be. The journey will be profitable, I assure you. We'll see you in the next segment. Hello, and welcome to Elite Trend Trader segment number 2. My name is Frank Bunn. In this video, we'll be covering the system logic. This logic is the primary building block for system entries, setups, and risk control that we'll be discussing in future installments. We'll start by taking a look at trends and deviation, and next learn all about the exponential moving average fan, a fascinating and exceptional recurring trend pattern. We'll follow this by examining how the pattern has performed historically, continuing with the empirical edge based on years of my own research and development, and finally conclude with a few words about market timing versus forecasting and the importance of the former. This segment will give you a solid foundation for the setups which come next. Let's take a look at trends and deviation. This graphical representation of an uptrend demonstrates price oscillating around a long-term upward moving average in price. In statistics, this central value, or typical value denoted by the upward sloping green arrow, is referred to as the central tendency. Here's the same graphical representation of a downtrend in price. What you'll notice is that deviations above this central tendency tend to be market tops as long as the trend continues down and doesn't reverse, and that deviations below the central tendency tend to be market bottoms or reversals as long as the trend continues up and doesn't reverse. It would seem obvious then that these deviations would create low-risk entry opportunities, assuming the truth of the trend as we learned in the last video, and the reality that we aren't and can never be certain about what is going to happen next. But as you'll see, you don't have to know what happens next in order to profit. So how do we establish the central tendency? What is the basis for this analysis? The tool we're going to use is called the Exponential Moving Average Fan, or EMA fan for short. On a price chart, we want to place the 18, 50, 100, and 200 period moving averages on the chart simultaneously. When they are lined up in sequence, 18, 50, 100, and 200, as seen here graphically, we have established an exponential moving average fan. We'll look at plenty of examples, but first I need to be certain you understand the tools you're using. Let's define it. The exponential moving average, or EMA, is effectively a weighted moving average. With the EMA, the weighting is such that the recent day's prices are given more significance than older prices. The theory behind this is that recent prices are considered to be more important than older prices. If you're interested in the exact algorithm which produces the exponential moving average, I've provided it here. There will be a quiz on this later, so be certain to take lots of notes. Okay, back to business. Similarly, an EMA fan may evolve in a downtrend in price as well. Here we see an inverse of the long version, this time beginning with the 200, then 100, then 50, followed by the 18. The moving averages must all be in line and line up in the proper sequence. They are generally equidistant and moving in the same direction. Here's an example of what it looks like on a price chart. Notice the EMAs are stacked from lowest to highest, equidistant and moving in the same upward direction. And here's an example of what the downtrend EMA fan version looks like on a similar price chart. Again, notice how the EMAs are now stacked from highest to lowest, equidistant and moving in the same downward direction. The key to this logic is understanding the intermediate and long-term trends defined by the EMA fan itself. We want to establish the 18 and 50 EMAs and their relationship to one another, as well as to the rest of the EMAs, as the intermediate term trend. We also want to establish the 50 and 100 and 200 EMAs and their relationship to one another, as well as the rest of the EMAs, as the long-term trend. This will allow us to qualify the macro trend patterns and eliminate subjectivity, which is a common problem in pattern analysis. The short-term trend is the price movement itself, which we'll get to later. For now, you just need to understand the difference between the two trends, and that they'll be working together and apart to facilitate proper trend analysis. Let's move on and make a few important notes about the EMA fan before we get to historical performance. Always remember that moving averages individually are not predictive indicators. However, they are moving support and resistance levels. This is very important. Additionally, they signal long-term trends if configured properly, as in the case of the EMA fan, for example. As such, they offer solid empirical predictive value used properly as long-term trend indicators. And since you know the truth of the trend, you know that a price trend, once begun, is more likely to continue than reverse. Okay, so let's look at how the EMA fan has performed historically. Examining the Dow Jones Industrial Average of 30 stocks during the recent period of July 2001 through July 2013, there were a total of 26 EMA fans on the index using the daily interval price chart. There were 8 false signals, giving us about 70% winners. Not too bad. However, the amazing thing comes next. EMA fan uptrends signaled 14,800 up points during the period, and 12,000 down points in the form of EMA fan downtrends during the same period. Compare this to the roughly 5,000 buy and hold points gained during the same 11-year time interval. So the total EMA fan points were a potential 26,000 with an average gain or loss per fan of about 1,000 Dow points. Although it wasn't possible or wouldn't be to pick the tops and bottoms exactly, the EMA fan as a market timing tool cannot be disputed. Not only did it give you a total of 26,000 potential points in which you could have profited from up and down movement in stocks, it clearly kept you away from the major bear markets and assured you were invested for the long-term bull runs. That's a powerful tool, and one you're going to learn to use to consistently make money trading stocks or anything else that can be charted. Let's take a closer look. During that 11-year period we saw in the previous slide, there was 1 6,000-point trend, 4 2,000-point trends, 4 1,000-point trends, and 8 500-point trends. This demonstrates the truth we learned about in the truth of the trend. The nature of a trend is continuation. Here's an EMA fan signal on the Dow during that period. Notice how the price reverts to the long-term mean, which we know to be the central tendency. Also note that these contractions don't change the price trend as defined by the exponential moving average fan. Here is another example. If you notice the tendency for price to reverse off the long-term legs of the EMA fan, you are correct. I'm going to teach you how to set up low-risk entries at these opportunities. Let's cover the empirical edge that I mentioned at the beginning of the video. Statistically, with the EMA fan in effect, deviation or breaches from the central tendency down below it for uptrends and up above it for downtrends, that average being either the 50, 100, or 200 EMAs, is typically less than 5%, as long as the EMA fan remains in effect. This is really, really important information. So what we're looking for here is both the EMA structure providing a basis for the long-term trend, and also we'll be using the EMAs as long-term support and resistance levels to target low-risk, high-probability entries. So what does this mean really? Well, if we consider our price graph of the central tendency as seen previously, given the average is either the 50, 100, or 200 EMA, which is one of the legs of the long-term trend, breaches of these averages typically don't exceed more than 5% in terms of stock or market price. This is important because we'll be using this valuable tool to establish the entries that are most likely to result in profit. Let's continue with the empirical edge. With the EMA fan in effect, a breach of one of the EMA fan legs, either the 50 or 100, is more likely to bounce on the next longest EMA fan leg, being either the 100 or 200, than it is to reverse. This is extremely important and ties into the truth of the trend. Make note of this fact before proceeding. And let's take a look at an example of this. Here you can see two cases where a price bounce on the 50 EMA did not immediately reverse but traded down to the 100 EMA before reversing. This demonstrates the power of the long-term moving averages to control price when the EMA fan has evolved. We will be using these tools as well as price action to consistently profit from this recurring trend pattern. Now a quick recap of the empirical edge. The EMA fan is not an indicator of future price performance. Rather, it is an exploitable technical edge where the most likely occurrence will be a continuation of the existing trend. Recall our lesson in randomness. See, we don't need to know what will happen next. We only need a recurring analytical edge around which we'll structure low-risk entries and a risk-based game which allows us to take profits which are many times larger than losses, thanks to the giant trend continuations that the market randomly hands us. We'll complete this segment with a few words about market timing and forecasting. Market timing is the use of specific technical tools, such as the EMA fan, to establish a context in which there is an acceptable likelihood of what is going to occur next. As a result, we can take specific action based on the most likely outcome of all random outcomes possible. This is really important. There is so much written about market timing, its advantages and disadvantages, and most of what is written is worthless information. A market timing model that incorporates a thorough understanding of randomness, as well as understanding market dynamics and the true nature of trends, is one of the most powerful tools you can ever have as a trader. To conclude, Market timing is the use of empirically sound, proven technical tools to create an edge in the markets and thus determine the most probable outcome. Market forecasting, on the other hand, is frequently hope and guesswork with overemphasis on outcome. We are making no attempt to forecast or foresee what is about to happen. We are merely acting on the most prudent times in a manner which controls risk and allows us to fully benefit from the continuation of the prevailing trend. Be certain to watch this video as often as you may require in order to integrate these core concepts. These are the basis of a very constructive belief system about market dynamics and one that every successful trader has adopted. Once you have integrated these concepts, you will begin to look at the market much differently than you have in the past, and much differently than most other traders and investors, and therein lies the benefit. We'll see you in the next video. Hello, welcome to Elite Trend Trader segment number 3. This is Frank Bunn. We're going to build on previously covered material in this video and learn the basis for system entries. Bear in mind that generic system signals must be understood prior to learning the actual trade setups which involve risk control. We are going to begin by discussing the continuation rule of thumb, also known as trend flow analysis. This is an extremely important concept that will later become the basis for any trend trade strategy. Many traders, even those with experience, are unfamiliar with this concept. We'll proceed with the EMA fan continuation analysis and cover exactly what we need to be looking for. There are two system entries and setups we'll be learning: exponential moving average fan continuations and EMA fan bounce patterns. We'll begin with the basic system entry for fan continuations and finish the segment with system entries for EMA fan bounce patterns. Just remember, this is a necessary continuation of the system logic. In the next segment, we'll look at the specific price action patterns and characteristics which form the trade setups themselves within the framework of this logic. Okay, let's get to it. The continuation rule of thumb states that for any trend setup, always trade the continuation of the trend. Allow the trend definition to evolve, wait for a reaction to that evolution, then establish a low-risk position anticipating a resumption of the original price trend. So the key here to any trend trade strategy should be an analysis or determination of the trend as seen here by the initial dark green surge. This is the expansion phase of the market, followed by a reaction to that initial surge as denoted by the red area here. This is a contraction phase in the market, after which a low-risk entry is taken at what appears to be the completion of the reaction or contraction phase, in anticipation of a resumption of the initial trend. This is referred to as trend flow analysis. Learning to perform this properly is the heartbeat of trend trading. The trader learns to take low-risk entries that allow for large potential winners. The result is consistent effort irrespective of market traded. For the sake of our system logic, let's further define these patterns precisely so we can learn the entry setups. There are two variations, as you know, fan continuations and fan bounce patterns. We know that the evolution of the EMA fan establishes the initial trend definition according to trend flow analysis. So for continuations, we look for a price reaction or correction which causes the 18 EMA to cross below the 50 EMA for potential long entries, or the 18 EMA to cross above the 50 EMA for potential short candidates, as we've seen in the most recent illustrations. And for EMA fan bounce patterns, we look for a price reaction or correction that causes prices to retrace to one of the EMA fan price levels, either the 50, 100, or 200 exponential moving averages, without causing the fan to lose its structure. Okay, with that understanding, let's learn the basic fan continuation signal. This procedure has 4 steps. Number 1, we verify the evolution of the EMA fan pattern. Number 2, we verify a price correction which causes the 18 EMA to adversely cross the 50 EMA. Number 3, we are certain that during the price correction, the price is bounced definitively on either the 100 or 200 exponential moving average, preferably the 100, as we'll see in examples coming. And number 4, when the full EMA fan resumes, we enter the market. That is, when the 18 crosses the 50 within the direction of the fan. Let's look at an example. Here we see the establishment of an exponential moving average fan in area A, followed by the specific correction reaction during area B as denoted by the amber colored bars, followed by a resumption of the trend in area C. Also note how the 100 exponential moving average contained the price where the arrow is pointing. Thus, the proper trend flow analysis according to the continuation rule of thumb. Let's examine a short example of the continuation pattern. Here we see the inverse EMA fan downtrend in area A, which evolved into a reaction to the 100 exponential moving average during the amber colored period in area B, after which the downtrend resumes through area C with a reestablishment of the EMA fan. Again, we just want to be clear about the trend flow analysis and how to read the macro trends. We'll get to the specifics of trade entry and risk control in the coming videos. Take a look at this additional example in a daily chart of Apple Computer. Here we see the initial EMA fan at point A evolve into a reaction to the 200 EMA at the beginning of the amber bars in area B, followed by a resumption of the trend and return of the green bars throughout area C. Just a quick note, the scripts which color the setups and trends in these examples are included in the training materials you received. I'll show you how to use them in the video titled Scanning the Market. These are really great tools that make analysis so much more easier. With the firm understanding of the continuation concept, let's proceed to system entry number 2, the EMA fan bounce signal. To complete this procedure, we first, number 1, verify the evolution of the EMA fan pattern. Number 2, we wait for a price reaction to bounce squarely on either the 50, 100, or 200 exponential moving averages, followed by number 3, where we ensure that the EMA fan remains intact. That is, the 50 period must be on the proper side of the 100, which must be on the proper side of the 200 exponential moving average. Here we see an established EMA fan which evolves a retracement to the 50 period exponential moving average as denoted by the blue line. And in this example, we see an established fan which evolves a reaction to the 100 period EMA in the stock of John Deere. Keep in mind, this is just a variation of the trend continuation rule of thumb and the basic trend flow analysis we recently learned. In this example, we have a downtrend. This details the precise type of trend flow we want to be trading. The establishment of the EMA fan during the initial down surge in price, followed by a reaction to the 50-period EMA leg of the fan. Recall the central tendency? It should be starting to make sense. In this long example, we see another variation. You should be starting to see that the EMA fan provides a simple, effective method for establishing the initial trend from which we want to see a tradable reaction in anticipation of the resumption of the original trend. Remember trend flow analysis. It is the key to trend trading. In this final example, we see a clear evolution of the EMA fan downtrend following the initial down surge in the price of Capital One Financial from its previous uptrend. Note the reaction to the 50 and 100 period EMA legs of the fan. I'm going to show you exactly how to trade this logic and profit from trend flow over and over again and again like clockwork. Let's recap so you're clear on all the fundamentals before we proceed. You now understand the continuation rule of thumb and trend flow analysis. We covered exactly how to properly analyze the trend with the EMA fan, which is really a form of tape reading. And we completed the necessary components of this segment with a thorough review of both fan continuation and fan bounce signal patterns. You may wish to review this video several times and make notes on key areas. It is imperative that you have a thorough understanding of the logic and basic entry signals prior to proceeding. So if we're all set, let's get to it. Hi, and welcome to Elite Trend Trader video number 4. My name is Frank Bunn. The journey so far should have been fun and informative as you've learned all the necessary basics to read trends. And now we get to the important stuff, the precise methods which we will use to exploit our newfound mastery of trend analysis. We're going to begin with the three forms of risk. It is absolutely imperative that you understand these. They are the gateway to learning how to spot the lowest risk, highest probability setups. We'll get into all the detail necessary later, but for now, I want to introduce you to these crucial forms of risk. You may notice that in the ebook there are only two, but I've added the third in an attempt to give you an even clearer view of risk and how to read and manage it. Next, you'll get a quick price action primer for those unfamiliar with this concept. We'll be using this valuable tool to set up trades and control risk. And finally, we get to the EMA fan continuation setup and its commensurate risk control, as well as the EMA fan bounce setups. This is my favorite low-risk reversal entry, and really the only tool you'll ever need to learn to spot great high-probability setups in any liquid market that can be charted. It's a very exciting setup. Let's jump right in with the three essential forms of risk. The first is setup risk. This is the initial assumption of risk in terms of points or percentages, which is the distance between the entry and the initial stop or exit price. The next is intrinsic risk. This is the setup pattern or technical characteristics which result in either more or less technical risk, which is confirmation in the form of support or resistance. And the last form is contextual risk, where the setup pattern evolves in terms of the trend, significant highs and lows, and the broad market correlation. Be certain to study this concept as much as necessary so that you thoroughly understand the various types of risk and how you can use them to profit consistently. They can and will make you rich. Most traders only consider setup risk, which is the most basic, obvious form of risk in its management. However, intrinsic and contextual risk are tools which will allow you to trade the trend from wherever it establishes itself. And you can learn how to sit in the strongest trends for a larger profit and run for the hills in counter trends and reversals which are not following through properly. I cannot overstate the significance of this knowledge. In my one-on-one coaching classes, risk and its thorough understanding as an intuitive trade management tool is the foundation for study. Learning this the hard way is what made me consistently profitable after years of trial and error. It will work for you too. We'll give this a break and head on to the price action primer. We must first define the long pivot intervals. The definition is as follows. A long pivot is a low point where the previous and subsequent lows are higher, and where the high which preceded the pivot low must be exceeded in future intervals. Notice in the simulated price chart example to the right, the long pivot is the red interval bar. Be sure to grasp this concept before proceeding. Here's an actual example of the long pivot. Again, note the logic. A low point where the previous low and the low which follows are both higher. Notice that the high which follows is also higher than the high which immediately preceded the pullback. Once this sinks in, you'll be spotting these like a pro in no time at all. Let's look at the short version, which is the exact inverse of the long pivot. The short pivot, by definition, is a high point where the previous and subsequent highs are lower, and where the low which preceded the pivot low must be exceeded in future intervals. Take a look at the short pivot in the simulated chart example to the right. It is the red bar. And here is an actual chart example. Note the logic, a high in price which is surrounded by lower highs, and is only defined as a high pivot once price exceeds the low established prior to the high pivot formation. It's pretty cool. We will be using this price action in a variety of contexts, including setups and trade management. Next, we want to be clear on a common pullback pattern which we will be employing frequently as well. It is the price action pullback. In my more advanced training, I teach tape reading and price action in much more detail, including more advanced reversals and trend change patterns. But here I just want you to be able to spot a pullback pattern by the following definition. For a long pullback, as seen in the example on the left, we have a series of uninterrupted highs and lows beginning with the highest high in price which evolves prior to the retracement pattern. you should immediately recall the trend flow analysis we covered in the last segment. Remember, it is crucial that the pattern consists only of lower lows and lower highs from the highest point in the initial thrust, after which price continues in the original direction. Take a look at the inverse short pattern in the example on the right. Here we see a low followed by the thrust and a series of uninterrupted highs and lows in the reaction patterns. You will learn to trade this specific pattern over and over again for easy profit. Let's take a look at some real chart examples of actual elite trend trader setups. Here we see a long version of the pullback pattern. Note several things here. Number one, the pullback pattern itself, the series of uninterrupted highs and lows from the highest point in the initial thrust. And two, note the trend flow analysis, the initial thrust which established the EMA fan, followed by the reaction, which in this case is the price action pullback pattern, which is followed by a continuation of the original trend as suggested by the continuation rule of thumb and the trend flow analysis. By the end of this video, you'll know exactly how to set these up. Also notice the green bar, which means the EFSE signal script would have allowed you to easily discover this setup in time for entry. More on this later. Here's an example of the short pullback price action pattern. Again, note the uninterrupted series of higher highs and lows originating from the lowest low in the initial down thrust. Learn to spot these and differentiate them from other opportunities that you will see. Here's one last example of a long version as traded in United Technologies, which is a Dow component. Again, check the logic. We want to continue with the price action primer and discuss the two-bar reversal. This is probably the most important thing you will ever learn in trading. And if you get nothing else out of this entire trading course, learning just this one pattern can make you a lifelong profitable trader. You'll be able to spot low-risk, high-probability entries over and over again. First, let's look at the long version on the left. Notice that we have a reversal bar, the red one, also called a doji bar in Japanese candlestick charting. What is important is the low price action which precedes it. Notice how the previous interval has a tail which makes a low. Then notice how the red reversal bar tail bounces on the low level established in the previous interval. This is the key to the setup. Take a look at the short version on the right. We can see the inverse. Notice how the red reversal bar bounces on the high level created by the wick of the previous interval. Let's define this exactly so you have a firm understanding of the principle. You may want to make a note here. By definition, a long reversal is a price interval whereby the opened and close, the body of the candle, are above EMA support and the tail of the candle, which is the full interval range, extends below EMA support, either testing or bouncing, and also below the low of the previous interval. To be clear, let's analyze it. Here we see the definition in action. Notice the reversal logic, which is the relationship of the red reversal bar and the low created by the previous interval. Remember that the red reversal bar range must trade over the low of the previous bar, with the tail trading down through it. This means the reversal bar has successfully completed the low-risk reversal off the previous level. And notice that the reversal bar is also bouncing squarely off one of the EMA fan legs. This is the key to the setup. Let's look at some real-world examples so you can be certain you grasp this concept. Once you realize the power of this tool, you'll be spotting these everywhere. But before we get to the actual setup, you must be certain and clear about the precise price action logic. In this example of a long reversal in Boeing, we see a green reversal bar at point A. We can clearly see that interval A is bouncing on the horizontal line on the previous low at point B. And the reversal bar is also bouncing off the 50-period exponential moving average line, which is the blue line. A quick note. Take notice of the pullback pattern in the example, a smooth series of lower lows and lower highs into the pattern. The reaction to this pattern is severe and profitable. This is what we want to trade. The really neat thing about the original signal EFS scripts is that I have programmed all the requisite logic into the script for you. So when you see a green bar, it has all the necessary A, B, and C logic. All you have to do is decide if you wish to set up the trade. More on that later though. With this in mind, let's examine the short counterpart. By definition, the short reversal is a price interval whereby the open and close, which is the body of the candle, are below exponential moving average resistance, and the tail of the candle, the full interval range, extends above EMA resistance, testing and bouncing, and also above the high of the previous interval. It is the exact inverse of the long. Let's take a look at the specifics to be certain. Here we see the red reversal bar, which has a range that trades under the low of the previous interval. However, the high of the wick trades over the high of the previous candle, causing the reversal bar to properly bounce off that level. Meanwhile, the reversal bar simultaneously bounces off the longer EMA line. Let's verify this with a real chart example of the pattern. In this dynamic material short trigger, we see a red-colored bar reversal at point A. We can also see the high of the previous interval is tested by the red reversal bar with the horizontal line at point B. And we can also see clearly that the red reversal bar is bouncing on an exponential moving average simultaneously. Be certain to study these precise price action patterns prior to proceeding. They are the building blocks for the setups. Do not proceed to the setups without understanding all of the trend and price action logic discussed up to this point. So if you're good to go, let's proceed with the setups. We'll start with the EMA fan continuation. The procedure is as follows. Number 1. Place a buy, long, or sell, which is a short stop, 2 pennies above or below the interval which resumes the EMA fan. Next, place a horizontal chart line with a price marker, see examples below, at your entry price. Next, locate the nearest most recent reaction high or low within the price correction, which bounced off the 100 or 200 EMA prior to the continuation, or the most recent high or low pivot which precedes the pattern, which we saw in the pivot explanation. This pattern will be lower for longs or higher for shorts. Place a horizontal chart line with a price marker 2 pennies above or below this level. Place the maximum risk stop order here. Then, calculate the amount of pennies or points between the two levels by subtracting your entry price from the initial stop price. And finally, with number 4 above is your initial risk, referred to as R. Calculate this as a percentage of the entry price by using the following formula. We divide R by our entry price. This quotient is your percentage risk for the trade. Let's see how this works on an actual trade chart setup. The setup entry is 2 pennies over the high of the first green bar in the continuation. Next, we establish risk as either a pivot, which precedes the continuation, or the low of the reaction period, as denoted by the amber-colored bars. So we establish a stop 2 pennies below either risk level number 1 or number 2. If we choose number 1, the risk is 51 cents or 9.81%. Let's check out a short example. Here we establish an entry at the resumption of the downtrend at point A, 2 pennies below the first red bar, and place a maximum risk stop 2 pennies over the high of point B in the reaction pattern. This is why we learned about long and short pivots in the price action primer. These pivots are incredibly useful for setting up trades and reducing risk. So area C is the risk window, which for a short and Apple computer is reasonably small at 17.62 points or roughly 4%. Let's examine one more to be clear. Here we have a long EMA fan continuation in LinkedIn Corporation. Notice that the first green bar that resumes the trend, we want to establish a high stop pursuant to the setup rules. Since that doesn't fill, we continue to move the stop down over the highs of the subsequent green bars until filled. The trade triggers at the 174.89 level, enabling us to place the initial maximum risk stop at the first previous long pivot, which is 165.13. The risk here is 9.76 points, or approximately 5%. We will see additional examples of this later, but now let's move on to the EMA fan bounce setup and risk control procedure. This is my favorite setup of the two, the one I use most for directional trading. I employ the EMA fan continuation setup you've just learned for income generating options positions mostly, as we will see later. To set up a fan bounce trade entry, we first place a buy for a long or a sell for the short stop 2 pennies above or below the reversal interval. This is the trigger bar. Then we calculate the height of the trigger bar in points or pennies, add a few pennies to this number for wiggle room. Then we subtract for longs or add for shorts the number derived from step 2 above to your entry price established in step 1 above. Place the initial maximum risk stop at this level. And then we place a horizontal chart line with a price marker at your entry price. Place another horizontal chart line with a price marker 2 pennies above or below the number established in step 3 above. This is your initial risk in points, referred to as R. Number 5, we calculate your risk in pennies or points in the same manner used for the continuation entries. Subtract your stop price from your entry price. And finally, we calculate step 5 as a percentage of the market price by using the following formula: R divided by entry price. This quotient is your percentage risk for the trade. Here is a real-world example for an actual trade I entered in FLT. My buy stop is established 2 pennies over the high of the green bar. My maximum risk stop is placed 2 pennies below the low of the green reversal bar, making area C my risk window for this trade, which happened to be 3.54 points, or 4.8%. Let's examine this Caterpillar short entry. My sell stop was 2 pennies below the low of the red reversal bar, and my maximum risk stop was placed 2 pennies over the high of the red reversal bar. This trade offered a maximum risk of 1.58 points, or just 2.2%. This is very low risk. I will teach you how to spot and set up these types of trades after you learn the proper intuitive tools. Be certain you are comfortable with all of this material presented in the segment. This may very well be the most important component in the training. To recap, we covered the 3 forms of risk and their definitions. Be certain to review this material. Then we learned about the specific price action that will help us set up trades and control risk. And we finally studied exactly how to set up specific trades and establish initial risk control. The importance of this information cannot be overstated. Do not proceed until all the rudiments are clear and the logic integrated. In the next video, we will be discussing the all-important concept of trade management, followed by low-risk entries in the subsequent segment. Things should be unfolding for you nicely, from the logic and trend analysis through setup and risk control. You should be starting to see the foundation for a solid, consistently profitable trading business. So if you're ready to proceed, let's move on to trade management. Hi, and welcome to Elite Trend Trader Segment 4.1. I'm Frank Bunn. Since we've studied the rudiments and now understand trade setup specifics, in this segment I'll be teaching the trade management tactics which have worked the best over the years with this type of trend trading strategy. We're first going to look at follow-through and some key characteristics you want to look for in EMA fan continuation setups as well as EMA fan bounce setups. Trade management will follow with instructional and risk reward, where you'll learn exactly how to establish a risk game. This element is crucial. It has enabled me to consistently profit year in and year out. Structuring trade management with a risk game is really critical to your long-term success because it is one of the few clear-cut solutions to ensuring your losses are small and your winners are much, much larger. Next, we'll look at price action using some of the tools we've previously learned and how to integrate them into the trade management process. And finally, we'll examine a few trade management tips and tricks which I've discovered and honed over the years that will help you jumpstart your trade management expertise. Let's start with follow-through on continuation setups. Generally, the EMA fan continuation entries will be triggered while a stock or the market is in a longer-term base or consolidation pattern. This is good because that is where you can establish the lowest risk entries expecting a base breakout at some point in the future. But follow-through is crucial because we don't know when, how, or if the stock or market will ultimately follow through on the promise of the fan continuation and making new significant high, typically a 52-week high in the case of momentum stocks. Understanding the quirks of base consolidations will really help you assess follow-through. So the first thing we look for is momentum. We want to see the stock break out over any previous highs that evolved in the base and stay on the proper side of the 18 exponential moving average. It may even bounce on this line. We definitely want to see the EMA fan remain in effect and look for support and resistance levels breakouts. Next, we want to look for high and low base breakouts to new significant highs, which as stated are usually 52-week highs and lows. Let's take a look at that LinkedIn trade we examined in the previous segment and analyze the follow-through. First, we notice price strength staying on the proper side of the 18 exponential moving average. We can also see the price breakout over key levels within the base and behaving quite nicely with 1 and 2 bar reactions as the price pops higher. In my more advanced training, I detail how to read these types of trends and look for reversals prior to the base breakout, but for now, if you just grasp the standard price momentum, you'll be fine. Ultimately, you can see the fan continuation resulted in a new 52-week high in the price of LNKD. I'll show you how to move stops and continue to reduce risk and lock in profit in just a minute. But first, let's look at follow-through in the EMA bounce setup. In some ways, these are easier because there are several specific things which must occur. First, price momentum must be sufficient such that it breaks out over or under, in the case of shorts, the high or low in price which preceded the reversal. Next, we want to see price breakout over or under any remaining EMA fan legs, which are the long-term moving averages, which might be in the way either higher or lower. Next, we'll be looking for price to breach the support and resistance levels within the larger base, if applicable. And finally, if applicable, we'll be looking for base breakouts and new 52-week highs or lows. Let's check out an example of this in action. In this EMA fan bounce reversal in Boeing, we see how the price popped over the 18 exponential moving average, which was in the way initially, and then proceeded to break out to a new high. The interesting thing about these reversals is that in very high momentum stocks near 52-week highs, you'll see these set up such that there is much less resistance overhead than with the EMA fan continuation, which tends to evolve much lower in the base consolidation. This is one of the reasons I prefer the reversals to continuations when it comes to directional trading. Notice too with this example that it is less than 5% down to the next leg of the EMA fan, which is the 100 period moving average. This is the option window we'll be learning about later when I show you how to use these reversals to generate income with option setups. Now that we're learning what to look for in terms of follow-through, let's take a look at how to establish a risk game for each setup pattern. The game is easy to learn. Start with the procedure by establishing 1. The initial risk pursuant to the rules of risk control specified earlier in the previous segment. This amount, the points and percentage as we know, is called R. And then use the R amount to size your position such that all entries have the same risk regardless of the amount of initial market risk. For example, if you only want to risk $200 on a trade and your R is 50 cents, your position size would be 400 shares. And then multiply your R by 2.5 and also by 3. This establishes the target area. You'll see an example in a moment. And for 5, okay, it sounds complicated, but it really isn't. We want to exit the trade either when the prices enter the target window or when the maximum risk stop is hit. Here's an example of the risk game in action. We establish the entry at point A and set up the trade according to the rules. Our initial stop is at point B. This gives us a risk window in area C, which becomes the R amount that is used to determine the target. It is also used to size the position. By multiplying that R by 2.5 and 3, we have a target window in area D. Do not proceed until the risk game is clear. The interesting thing is that you can establish a variety of targets by adjusting the multiplier for your R. But you should see that by controlling your risk and keeping it at 1R and allowing the trend to take your position to 2, 3, or even 4 times that R is how you ultimately win the game and get rich. This has been the cornerstone of all my trading methodologies, regardless of what system I'm using to trade any market. It should really become clear now as you learn more and more about the strategy. The idea is to take positions in stocks and markets that demonstrate the strongest trends given the presence of the EMA fan, and then trade the low-risk entries that allow a resumption of that strongest trend to carry your profits to several times your initial risk. This is the key. It will change your trading and it will also change your life. Note also to the right that this option window is suggested again by the area C. Just make a note of this area as we will be using it for the market neutral trades you'll learn about later in coming segments. Let's move on and learn a bit about how to use price action to help us manage these trades. The R game is great, but the R is theoretical. The price action is what the market is actually doing and cannot be ignored. So the goal of intuitive trade management is to couple low setup and intrinsic risk patterns with price analysis such that you are able to push the risk-reward skew as far in your favor as possible. This is what we want to achieve. How do we do this? We'll be using the pivot points we learned about earlier. First, we establish the initial risk pursuant to the risk control method for the entry type you're using. Then, as subsequent pivot low points for longs or pivot high points for shorts, as these evolve, we move a stop 2 cents below or above that new level. In the simulated chart to the right, you will see an example of this. By moving stops higher, according to the reaction lows dictated by the pivot points, you can further reduce risk, then eliminate it, then start to lock in profit, all while you play your risk game. This is a powerful 1-2 punch when it comes to trade management. But let's not stop there. Next, we want to watch for the highs if long or lows if short of these reactions to contain the price. Simply stated, after the price breaks out and gives you a higher stop, you want the market to stay over that reaction high, and we'll see some examples of this. And then we continue to trail stops and monitor breakouts as the trend ensues. And finally, we exit the trade when a trailing stop is hit or a pattern breakout fails. Keep in mind you can use one, two, or both forms of price action trade management or use them instead of an R game. Developing your own style is paramount, provided that whatever you do it consistently. So let's go back to that R game setup we first analyzed and look at it in terms of price action management. We see the entry, stop, and initial risk as before with points A, B, and C. Next, we see the pattern breakout at point D, which holds, enabling us to move a stop to the low of point E, which we move from point B, reducing risk. Next, we have another high, small correction to point G, and subsequent pattern breakout at point F, which enables us to move a stop to the low of point G. Now we have eliminated risk and locked in profit. This is called working the trade. The same thing happens at point J, allowing us to move stops first to the low at point H and then to the low of point I. Eventually the trend weakens and price falls back through the pattern breakout in area J. Use this method in combination with an effective R game to consistently reduce risk and lock in profit, and you'll be working these trades like a pro. Remember randomness though. This is a game of random outcomes. We can't control it, but we can manage it. Let's conclude this segment with some helpful management tips. One of the best things we can look for is long-term EMA respect. That is, multiple bounces on the EMA lines over time. There must be at least 3 to confirm it. See the simulated example here to the right. Next, as you have learned now, you never want to catch the proverbial falling knife. Wait for the proper reversal pattern for entry. Also, when it comes to momentum, you want to look for stocks with very high relative strength. More will be discussed about this later, but there are numerous publications and sites which list relative strength. It is not the relative strength technical analysis indicator, but rather a method of ranking stocks according to how strong their trends have been in the previous 52-week period. The ranking is from 0 to 99, with the strongest stocks in the 90s and high 90s. This means that the stock has been outperforming over 90% of all other stocks in terms of price appreciation and price momentum. This is a very powerful tool. Finally, look for earnings news. The stock should be trending for institutional accumulation reasons, but be careful with stocks that have earnings news to be released in the next few days or week or two. And as a rule, I do not enter trades in stocks that are in any form of merger and acquisition activity. This makes them vulnerable to non-technical moves. Definitely review all of the management tactics presented in this segment and only proceed when you're ready to go. So if you are all set, I'll meet you in the next installment on how to find and locate the lowest risk entries. This is really a great part of the training. Hello again, and welcome to Elite Trend Trader video number 4.2, Low Risk Entries. This is Frank Bunn. Now that you are familiar with trend analysis, setting up trades, and risk control in the form of setup risk, we're going to proceed with what I believe to be the most important aspect of learning to trade trends effectively. That is, using the concepts of intrinsic and contextual risk to locate and consistently set up the lowest risk, highest probability trades. What we're talking about here is a combination of intuition and empirical experience. Over the course of many years, I've learned that the market will arbitrarily hand you lower risk entries based on specific technical aspects which randomly happen to be present at the time, as well as macro trend contextual patterns which may also be present. As we already know, the presence of the EMA fan is just such a contextual pattern and places us in the sweet spot of the trend where we are most likely to encounter massive continuation. With this understanding, I'm going to teach you a suite of specific tools which will improve your performance with the system and virtually guarantee your success over time. Simultaneously, you'll be learning the art of intuition, which I consider to be indispensable in this game. So let's get started. We'll begin with tiny triggers and reaffirm an easy setup risk technique. Next, we'll cover double reversals and double EMA bounces, both phenomenal methods for spotting low intrinsic risk entries. We'll follow with EMA support and resistance study, as well as EMA surfing, which we briefly covered in the last segment at the end but did not fully discuss. Finally, we'll conclude with combos, combinations, and how to combine all these components to routinely enter the lowest risk setups. This segment will take you a long way towards the development of your own style. As you learn the system and integrate it, one, some, or many of these tools can be used to sort and filter trades according to your specific preferences. Let's start with tiny triggers. Somewhat self-evident, here we're looking for short in terms of high to low range doji reversal bars. These very frequently evolve at the end of the pullback patterns we previously discussed as trade volume contracts and as the consolidation nears its completion. In this simulated chart, we see two patterns, a long one on the left and a short version on the right. Although it is possible to measure small triggers in terms of points or pennies, I've found the best way to do it is by percentage. That is, take the height of the trigger bar as a percentage of the entry price. To do this, simply take the quotient of the trigger range in points and the entry price. So you want to divide the trigger bar range by the estimated entry stop price. The market will randomly hand you very low risk setups in the form of very small trigger bars. Let's look at a few examples. Here we have two examples of recent entries in Capital One Financial on a daily chart. The first thing you'll notice is how short the green trigger bars are in comparison to what appears to be the average daily range of capital 1. As a percentage, the first entry is 1.5% and the second offers only 1% in risk. This is extremely low risk. What I want you to consider is how much easier it is to play an R-based risk game when your initial risk is this low. Look how easy it would have been to get 3, 4, or even 5R, that is 5 times your risk out of these trades. Focusing on small triggers is in itself an excellent strategy and takes full advantage of market randomness heading in your favor. In terms of EMA fan continuation patterns, as in this example, you'll find that the market will arbitrarily hand you low-risk entries whereby the pivot lows, or highs if short, will be very close to your entry. Here we can see just such a low-risk entry of about 2.7% in a higher price stock. This is the continuation equivalent of the tiny trigger bar, so look for these as well. Next, let's consider double reversals. Double reversals are simply 2 consecutive reversal triggers that meet the specific price action definition for entry. Simply stated, it's like having 2 signals evolve concurrently. This is a powerful pattern because of the triple support or resistance you'll notice at the reversal level. Also, if both reversal triggers are bouncing on the long-term EMA, this makes the pattern even more probable. I rarely, if ever, get stopped out on these breakouts. The key to this intrinsic filter is that you basically have 2 consecutive setup signals happening. Let's take a look at some examples. In this daily interval chart of Bristol-Myers, we see an evolution of a double reversal off the 50-period EMA, a very powerful pattern that resulted in an explosive move in the direction of the original trend. These moves are not uncommon, so much so that this tool can be its own trading system or primary filter or sorting tool. Let's proceed with a double EMA bounce. In this case, we're looking for both the trigger bar and the previous interval or intervals to be bouncing off the long-term exponential moving average. This is another powerful low intrinsic risk pattern. The key here is massive support or resistance in the form of 2 consecutive exponential moving average hits. Let's take a look at a few examples so this pattern is clear. In this caterpillar short setup on the daily chart, you'll notice that both the red trigger bar and the previous interval have both bounced on the 50-period EMA. The resistance in this case was so strong that the entry bar, which followed the red trigger reversal, also bounced squarely off the line. Remember, you don't want the body of the candle or the range of the interval to trade through the line. You want the range or body to be on the proper side of the EMA and see just the tail or wick trade through it. This is a proper bounce or test of the line. In this next example, we'll take a look at Boeing again, which we observed in an earlier example. This is a low-risk double EMA entry off the 50, which is classic. Over the years, I've frequently traded these exclusively, creating entire trading systems based on the double EMA bounce. It's that powerful, and in many cases, in random sampling, I can win 9 out of 10 of these. I've also had samples where I win every trade. The combination of the EMA fan trend pattern and the solid bounce-off massive support provided by the long-term average is just the type of low intrinsic risk setup you should be looking for. Let's move on to double and in some cases triple EMA support and resistance study. In this scenario, we see the trigger bar bouncing squarely off 2 or more long-term EMAs. This is another powerful pattern. The key being 2 or more simultaneous EMA hits by the reversal trigger bar. You can see the basic examples here in this long and short simulated chart graphic. Let's look at a few real-time examples though to solidify the concept. In this chart, we see the green reversal bar bouncing off both the 100 and 200 EMAs. Shortly after the evolution of the fan, a powerful pattern which results in a massive trend continuation in the follow-through. In this short example in John Deere, the trigger bar is also hitting both the 100 and 200 EMAs simultaneously. I knew intuitively that this stock would fall, at least enough to profit. In this next example, we see a very large trigger bar in Travel Zoo on a short setup. Here the trigger is hitting the 18 and the 50 simultaneously. Notice how the 18 EMA continued to contain the price as the stock trended lower. The great thing about this pattern, or any of the tools I'm teaching you, is that you can ultimately decide what type of patterns you wish to trade based on your own empirical experience and testing. This will give you supreme confidence in the system. In this last example, we see another long entry with the trigger bouncing off the 100 and 200 EMAs at the same time. This particular pattern is so probable you will rarely see a loss. The support or resistance provided by the long-term averages in combination with the power of the reversal pattern itself will almost always result in some sort of profit. The next tool we want to consider is something I call long-term EMA surfing, which we briefly mentioned in the last segment. The idea here is that the price of the stock or market has been testing or respecting the long-term moving average in question during recent reactions or consolidations which have traded to it. This is also a powerful tool and takes full advantage of market randomness and the central tendency. In this case, as you can see in this simulated chart example, the trigger bar has tested a long-term EMA which has also been similarly tested at least twice in the past. What you want to look for here is a total of at least 3 hits on the line. It takes a little more effort to integrate this tool. You have to become accustomed to a bit more analysis and begin to watch for historical testing. Let's go back to that caterpillar short we analyzed previously. Here we see the double EMA bounce off the 50-period moving average at points B and C. But also notice that about a month earlier, the price respected the 50 EMA with a firm test and bounce at point A. By the time the reversal evolved at point C, the market had begun to surf the 50 EMA line. Here's another example. In this case, we have a very powerful EMA fan uptrend which evolves a green trigger bar at point C. This reversal is bouncing off the 50-period EMA. Notice, however, that the price had respected that same 50-period EMA at point B earlier, and about 6 weeks earlier than that at point A. Learning to spot surfing is a great way to improve your win rate and climb onto the big institutional winners. Finally, let's take a look at combos. This should be self-evident at this point, but frequently 1, 2, or more of the specific intrinsic patterns we've learned in this segment will evolve simultaneously. So the key here is 2 or more low intrinsic risk patterns. As seen in this simulated example, we have double reversals, EMA surfing, as well as double EMA bounces. As previously suggested, the great thing about intuitive analysis is that you can test and choose the specific criteria you wish to employ based on your own experience and testing. The reason this is so powerful is that if you're acting in harmony with your preferences, you'll be more likely to follow your plan and act on the analysis and the signals. Let's look at a few examples. In this example, in the Dow Jones Industrial Average itself, we can see all the low-risk intrinsic entry tools appearing at once. There is a double reversal denoted by the 2 consecutive red bars. There is EMA surfing on both the 50 and 100 period moving averages. We have a double EMA bounce on the same 2 averages, as well as a double 50 and 100 period EMA resistance. It should be no surprise that the market trended lower and that the trend initially established by the fan continued. It really is impossible to have lower intrinsic risk than this. In this chart, we see the follow-through on the same signal we just analyzed. This is the downtrend which began in August of 2001, about 6 weeks prior to the 9/11 terrorist attacks. It details the sheer power and potential of the system. In this last example, in the short in John Deere, we see multiple patterns as well. We have double EMA bounces coupled with surfing. Specifically, look at the purple 200 period EMA line and how price consistently respected it throughout the consolidation pattern. That was a huge clue that the red reversal trigger would be a low-risk entry. Learn to read the tape like this. Use the tools you've learned in this segment to spot the lowest risk, highest probability setups. Until your intuition becomes fully honed, here's a mechanical or automatic way to get started testing and building a profitable trade sample. I create these mechanisms all the time and then test them with dozens of trades to see macro performance patterns. In this case, you want to locate either a continuation or bounce entry pattern, and then perform proper risk analysis, specifically looking for tiny triggers. After which, you want to ensure that at least one of the additional patterns is present, either a double reversal, double bounce, the double EMA support or resistance, or the long-term EMA surfing or EMA respect. This is a great way to get started and begin to develop your own style, so give it a try. Let's do a quick recap of this segment since the information here is so important. We covered tiny triggers, which is all about low setup risk. We talked then about double reversals, where we are really just looking at double signals trading concurrently. We also then covered double EMA bounces to provide even more support or resistance. Long-term EMA support and resistance itself was discussed. The consecutive bounces off the same line are very, very powerful. Next, we looked at EMA surfing and long-term respect of the EMA fan legs, which is a great analytical tool. And finally, we covered combinations of the above patterns. In closing, we want to create a system by only sampling trades which meet the lowest risk intuitive entry criteria. These components can either be predetermined through specific system mechanics or intuited on a trade-by-trade basis. Study the material in this segment as often as you need to in order to integrate the concepts and begin to fully comprehend the power of the three types of risk and how to manage and use them to your greatest benefit. This will really change your trading in ways you've never imagined and truly take your game to the next level. If you're ready to proceed, we'll take a break from the new concepts in the next video and look at some historical examples of the system in action. See you then. Welcome to Elite Trend Trader, segment number 5. I'm your host, Frank Bunn, and in this video we're going to take a look at some historical setups and market moves, detailing how I use the system as both a market timing tool and also a specific trade setup system. So let's jump right in with some examples of the market timing model over the years. In this first slide, we have a weekly version of the Dow Jones Industrials detailing the 2012-2013 bull market. Notice the reactions to the 50-period EMA as well as the progression of the EMA fan. The number of individual trades and massive breakouts in stocks during this period was unprecedented and in my recollection only exceeded by the bull market in the late 1990s. And speaking of, here's the Dow during the 1998-99 bull market. Notice how the reaction to the 100 EMA does not change the structure of the EMA fan. In a similar 4,000-point move like that found in the 2012-2013 run, the number of individual stock breakouts during this period was truly incredible. Here's an example of an EMA fan continuation setup on the Dow daily chart. Notice how, in this case, the fan first evolves as the amber bars start to turn green. The market retraces to the 50-period EMA, which is very common prior to the fan resumption. In this example as well, we see a few bounce setups in the Dow in addition to another 1,000-point market timing signal. The power of the EMA fan as a market timing signal for me cannot be overstated. It continues to give me the truth about what is actually happening with the trend. While all the pundits speculate about the future, I can be scanning for probable trades. Here's another example of an EMA fan continuation setup in the Dow. These have not been uncommon over the years and are great signals for me to increase the leverage I'm using in my individual stock trades. Going down, here's the fan which evolved into the 2008 financial crisis. Notice how the fan evolution was present way up in the 12,000s, long before the real selling cataclysm began. The EMA fan has kept me out of every bear market since the 1990s when I began trading. Here's another example of the EMA fan continuation setup in the Dow. This is a resumption as compared to the beginning of the fan as we saw in earlier examples. Notice the first support at the 100 and 200 period EMA fan legs prior to the continuation of the trend. This is very common. Here's another market timing signal. I never ignore these. We analyzed this setup in the last segment. Here's the Dow timing model signal on the daily chart which preceded the bear market crash into September 11, 2001. In this case, the fan evolved into the downtrend much earlier, as far back as July of that year. In terms of individual stock trades, here are two signals in Zillow, ticker symbol Z, a very popular momentum stock, darling at the time. The subsequent breakout and the trend continuation almost double the stock at this point. In this classic EMA fan continuation pattern in MDSO, observe the firm support at the 100 EMA which preceded the takeoff. You can learn to spot these. In the coming videos, I'll be teaching you how to trade options to get the greatest bang for your buck from these patterns. Here's an EMA fan bounce set up in Green Mountain Roasters, which resulted in a huge percentage gain in the stock. And two signals, one stop out and one base breakout in QCOR. This really exemplifies how the risk game works best and how it can be most effectively used with this strategy. Very small losses of 1 times R and big multiple R winners. In this case, the base breakout resulted in well over 10 times risk to the upside. This is not totally uncommon. Here's the early stage base breakout in the now infamous Netflix bull run, preceded by the reversal signal you see there in late June. The initial rally surged almost 50 points and close to 10 times in risk. Here's a very low-risk entry in Sam Adams, the beer brewing company. Notice how there is only a few points between the entry and the nearest long pivot in the amber-colored period. This is the key to setting these up, only taking the very low-risk entries the market randomly provides. And lastly, we'll look at an extremely low intrinsic risk trade I had in PCYC, another momentum stock darling. In the chapter on scanning, I'll show you how to target cheaper stocks which generally make larger percentage moves and have greater capability of doubling or tripling with these setups. Thank you for joining me on this trip down memory lane. As you learn the strategy and integrate its timeless principles, you'll compile your own trade samples filled with big winners and breakouts. Be certain to review all the material we've covered to this point. In the coming segments, we're going to turn the focus to options and how to use the system to effectively trade options before returning to scanning and day trading after that. So see you in the next video. Hi, and welcome to Elite Trend Trader video number 6. We'll be taking a break from directional strategy at this point and focusing on options during this segment of the course. Specifically, this installment will be a primer on the fundamental types of options positions we will be using to exploit the system. These are the best option strategies to employ with such a directional strategy. First, we'll be covering long options, which are the simplest method. Here, I'll show you how to use call and put options as surrogates for stock shares in directional trading, moving with the stock or market up and down. Next, we'll take a look at covered calls and puts. This is one of the lowest risk option strategies and very ideal for the elite trend trading method. After this, we'll learn about debit spreads and credit spreads. As you'll see, these 4 strategies are the best option strategies to take advantage of the directional mastery you'll be able to achieve with the strategy. So let's get started with long options. The ticket is to learn how to use call and put options in the proper configuration so as to have a leveraged surrogate to trade instead of shares of the stock. So this is what you do. Choose a leap, although these typically have an expiration month of 1 or 2 years out. Make this 4 to 6 months out is fine. For the remainder of this training, I will define any contract with a 4 to 6 month expiration date or greater as a leap. This will come in handy for the next part. Next, you want to avoid the wasting asset cycle. Do not hold an options position that has 2 months or less until expiration. During this time, theta, the theoretical daily decay of premium, goes exponential, especially if the option is out of the money. Next, we want to choose a strike price that is slightly in the money. Try 1 or 2 strikes in the money depending on whether the options chain trades in a 1, 2.5, or 5-point strike price. Next, we want to choose an in-the-money option that has a delta of 65 or greater. Here, the low 70s is best. This is the key benchmark for creating a surrogate for the stock shares. And finally, we want to ensure that the option is liquid and doesn't have a big spread. If you're an option trader, you know this is very relative. You have to work with what you're given. Also, if you're trading a weekly chart and you know the stock is a potential doubler or tripler, you can be less choosy here. This method will ensure that you're consistently choosing the proper option contract to trade instead of outright buying or selling short the shares of the stock. Let's look at an example. It's May of 2013. Stock ABC has evolved a great setup around $40 per share. You investigate the option chain and discover the January 2014 37.50s and 35s are good candidates with 65 and 72 deltas respectively. You choose the 37.5 option contract with a $4.25 premium. This gives you plenty of time for the trade to work out and the best chance to avoid volatility burn. If the stock trades to 45 in the first week, your premium will be worth $7.50 to $8 theoretically, right on track with the delta skew. And it will probably have a delta well over 80. What's really going on here? Let's examine the long option a little more closely. First of all, we're avoiding the cheap option trap and the wasting asset cycle. Inexpensive, out-of-the-money calls and puts are tempting, as are near-month contracts which have depreciated value. This is a strategy which I often see fail. The trick is to trade the leap as an effective asset. The truth about options is that theta, or time decay, is not consistent throughout the life of the option. That means that slightly in-the-money leaps 6 months or more away from expiration will realistically have little daily theta, or decay, given random price movement. Next, an even more important thing, is that we are eliminating the premium lag from out of the money to in the money. Have you ever bought an out-of-the-money call option, watched the market or stock rally, but have the option premium remain little unchanged? Exactly. As the option swings in the money, there is a premium lag. Now you should be understanding how to structure your call and put sales with leaps. So let's take a look at risk control with long options. Very frequently, I will use the entire premium amount as my maximum risk stop. So if I have a low setup risk plus low intrinsic risk in the trade setup, and add in low premium risk from the leap option given the leap value structure discussed in the last slide, and if the stock or market breaches my maximum risk chart stop, the contract should still have substantive value. So I'm always losing less than I expect. Plus, I have unlimited theoretical profit potential. Here are some leap performance tips. Number 1. A properly selected leap, call, or put option will not fluctuate with adverse price movement as much as you think due to substantial time to expiration and the avoidance of the wasting asset cycle. Number 2. Adverse price movement for longs will theoretically cause volatility to spike, thus supporting your premium indirectly. And 3. Under no circumstance will an adverse move of just a few percentage points in the stock result in a total loss of leap premium. And finally, number 4, this position has theoretically unlimited profit potential. The premium could double or triple if the equity makes an extended move. Aha! Now we're getting to the power of the trend trade combined with the big leverage of the stock option. While this sinks in, let's move on to the covered call and covered puts, although I use them less frequently. The procedure is rather simple. Number 1, we want to purchase or sell your predetermined share amount in round lots. This is your basic stock position in even 100 share lots. And then we simultaneously sell near month, the next possible expiration month, contracts 1-to-1 in correlation to your stock position. So 1,000 shares in a stock position would get 10 calls or puts. This is usually done in one transaction at the same time, but many times you can leg into the position by purchasing stock shares first, then after some amount of appreciation putting on the short call position. This can also be done by using leaps as the long position instead of stock shares, now that we know how to structure leaps as proper surrogates for shares. These would be debit spreads. In this procedure, we employ the long call or long put procedure found above to find the best leap option candidate for your long or short base position. And then we sell near month expiration calls or puts in a ratio of 7-to-10. That is, for every 10 calls or puts in your long position, sell no more than 7 calls or puts in the near month expiration date. The reason we don't sell short options 1-for-1 is because, remember, the leap delta is only in the 70s to begin with. So 7 short calls or puts will generally suffice for 10 calls or puts in the long leg. And no matter how far the market rallies or falls, your debit spread should remain profitable with a 7-to-10 ratio of short calls to long calls or puts. Now, if your leap has a hard delta of 80 or so at purchase, you may wish to short 8 calls or puts in the short leg of the spread. Whereas the above spreads will cost money given the debit because you get less money for the short leg than you pay for the long leg, credit spreads are the opposite. Here's how you want to structure these. Number 1, locate a striking price at or near as close as possible to your maximum risk stop on your trade entry. And then, number 2, sell your entire contract lot position at that striking price, whether the lot be 5, 20, etc. And after which, number 3, you move 1 or 2 striking prices lower or higher for short positions and buy 1-to-1 calls or puts. In the next video segment on how to use the system to trade options, I will be giving plenty of examples of these from recent trades that I've made. For now, I just want you to be familiar with the basic 4 types of option strategies we will be using to exploit system signals. You should have had several light bulb moments during this training where things start to make sense all of a sudden. Now is one of those times. The thing about options trading is that so many aspiring traders attempt to trade options, especially delta neutral positions, with no regard for the trend or lack thereof of the underlying asset. I can tell you that spreads in covered calls and puts always outperform when you have probabilistic direction built into the model. Simply stated, if you have a general idea about where the market is likely to go, you're more likely to generate the largest returns with the proper options positions. This is really the system key and the secret to this strategy. We have a really good idea that our setup is not likely to stop out, so we structure the best option position that profits throughout the range of possible random outcomes. Aha! Now we're talking. Review this material to be certain you have at least a firm basic understanding of the strategies. The picture will become much more clear in the next video. Now we can get to the important stuff. I'll see you in the next segment. Hi, and welcome to Elite Trend Trader segment number 7. In this video, we're going to be looking at how to use the option positions we learned about in the last installment in conjunction with the trend trade system signals and setups. Specifically, we'll be analyzing the best and most profitable ways to exploit the EMA fan continuation setups and EMA fan bounce setups. We'll first take a look at the method behind the madness, where I'll be giving you the logic behind the idea of combining options with a directional trading strategy. It really is one of the most powerful combinations I've developed. Next, we'll be looking at long calls and puts, which is rather straightforward, followed by covered calls and puts, as well as debit spreads, which are similar strategies. And after that, we'll cover the best way to use credit spreads as a primary income-generating vehicle. In conclusion, I'll show you some tips and tricks I've honed over the years to improve performance. One of the best things that you can learn about options trading with directional strategies is that the game is opportunistic. A lot depends on where the market or stock is trading when you open an option position. Let's jump right in with some of the logic I mentioned. One of the things we'll be trying to do with options is to finesse the profit window. Basically, we're going to structure the options position such that if the stock or market goes up, sideways, or down a small amount, the position will produce a profit. This is really important and ties into our analysis of randomness and random outcomes mentioned at the beginning of the training course. As you'll see, each opportunity will have a profit window, a sweet spot whereby any close within that window at, near, or sometime before the next option expiration period should theoretically result in profit. Immediately you should see the benefit of this and the advantages over pure directional trading. Although direction is ultimately more profitable with leverage, the options profit window allows for more leeway in terms of actual random outcomes. Monthly income can be generated consistently with the flexibility of the option profit window as opposed to directional trading whereby the market must move in your direction according to plan. Next, the important aspect of using options in this capacity is that they allow us to sell time. That is, by properly selling option premium, we can put ourselves on the statistical proper side of the option market. Since 80 or 85% of options expire worthless, one can surmise that the seller is more often the winner of the trade, with the buyer of the option losing most of the time. Selling time in the form of premium is a sound long-term strategy. As an extension of this, it is often easier to sell picks and shovels to the gold diggers than actually mine the gold yourself. So selling premium, that is structuring your options positions to sell calls and puts to the speculators, takes advantage of both the steady decay of time as expiration nears, as well as the flexibility of the profit window. And since the seller of options should never begrudge the buyer his profit, you'll be positioning your spreads so that no matter how far or fast the market rallies, you'll still profit. That is, the loss on the short leg of your trade will never exceed the gain on the long leg, resulting in overall profit. And finally, solid market timing plus market neutral positions is the success equation. Because you don't have to be spot on about the outcome of the trade, you have the flexibility of the profit window. And most importantly, if you're correct about market direction, option trading is always more profitable. Let's take a closer look at this profit window and see what we want to be doing. First, we definitely want to compare the maximum risk on the trade to any option premium sale amount. Because remember, we'll be keeping the entire premium sold if the market does nothing or moves against us a little. This is a huge natural risk reducer. Next, remember the EMA fan rule of support and resistance and look for setups which are preceded by strong 100 and 200 EMA support or resistance if shorting. Next, we'll want to use the EMA fan legs or the suite of long-term averages, as you know, in our analysis of risk and where we ultimately decide to place the option positions. After this, we definitely want to select positions that have the greatest possibility for profit given all potential random possibilities. We want to be casting the widest net, so to speak. And finally, regardless of whether we are spreading debits or credits, we want to consistently establish the same profit window. This may seem more complex than it is, so let's start to look at a few examples. Here's the reversal bounce setup in Boeing again. Whether or not we're going to trade covered calls or a debit spread, we want to establish the profit window, that area in which, theoretically at least, the position will result in profit sometime at or near the next option expiration date. Basically, regardless if the stock of BA rallies indefinitely, does nothing, or falls down to the 100-period EMA, which is rising daily, the covered call position or debit spread should be profitable. Here's another example in the explosive materials trade. We establish a target window with the options such that whether boom rallies indefinitely, does nothing, and goes sideways or falls back down to the 100 and 200 period averages, where it should bounce, the covered calls or the debit spread should be profitable. So what you should be starting to see here is that much of this depends on exactly where the stock is trading and the premium of the options, which are affected by volatility, at the time you put on the position. This is what I mean by finessing the profit window. with all the components, time, stock price, and interest rates, that affect the price of an option premium from one minute to the next in constant flux. We need to be flexible when using options with a directional strategy. For example, a setup might evolve halfway to the next expiration. We may wish to trade the current expiration or go out to the next one. Here we are again with the Dow Jones Industrial Short. The profit window will be affected by the amount of risk in the trade, as well as other technical factors related to the trend. Here, we would be looking for a put-debit position which results in profit if the market falls indefinitely, goes sideways, or rallies about 100 to 150 points or so. Remember, with covered calls, debit spreads, and credit spreads, all we're looking to do is generate consistent monthly profit that we can compound regularly, using our knowledge of direction and market timing and what is most likely to happen next. Here's one last example. With this LAD long setup, we would be looking to profit from the covered call or debit spread if the stock rallies indefinitely, does nothing, and trades in a range or falls less than 5% or so. Let's continue with the actual positions themselves. We'll start with long calls and puts, which is a directional trade designed to take advantage of the trend continuation with maximum leverage. As suggested by this simulated chart graphic, we're looking to use a leap call, selecting one according to the method we learned in the last video instead of purchasing the stock shares. For reasons discussed, this will cost a lot less, at the same time allow us to control risk with the selection of proper premium and take advantage of the extra leverage of the call option itself. The key here is direction, as trading the strategy as specified pursuant to the continuation and EMA fan bounce setups. As we'll see later, it will be possible to subsequently sell calls after the market or stock has rallied and leg into a debit spread. This is a technique which can be extremely profitable. If you're right about direction a majority of the time, you can wait for the stock to rally before placing the short leg of your spread or before selling the calls against the stock shares you purchased. This technique is called legging into a spread position. For most option traders who don't understand market timing or direction, this is a risky strategy. But when you can read the tape and determine what is most probable, it can result in much higher rates of returns for your positions. Let's look at how we're going to put on covered writes or covered calls and puts, as well as their debit spread counterparts. Here, when the trade setup is triggered, we'll be looking to purchase the leap and simultaneously sell the proper ratio of calls in the case of the call debit spread. And in the case of a covered call position, we would simultaneously purchase shares of stock and sell the proper number of calls for the short leg of the position. The key here is direction and the credit derived from the call premium sales. Let's take a breather and look at some management tactics for these positions. Sell the long position or cover the short sale and offset buy to close your short call or put if your maximum risk stop is exceeded. This will actually reduce your risk on failed breakouts because the short position premium will depreciate, resulting in profit. Simply stated, a covered call position which hits your maximum risk stop will always offer profit on the short call. This will partially offset the loss on your stock position. Next, at expiration, either allow your covered right to expire and be called away, or close the short position with available cash and sell next month's contracts in the same manner. This can be done with debit spreads as well. If the trend is still in effect but you don't have significant appreciation, allow the stock to expire worthless and hold on to your base long stock or call position. This makes the subsequent month easy to manage. Simply sell more calls according to the 7-to-10 ratio. Be certain the EMA fan is still in effect. In general, contrary to what you read about options trading, allow short call and put positions to expire worthless in most cases. Yes, if severely out of the money, they will be trading at 5 or 10 cents during expiration week and not offering significant theta daily decay. However, over time, the cost of rolling positions incurs significant brokerage commissions. When they expire worthless, they simply go away and cost you nothing. With these ideas in mind, let's move on and cover credit spreads and how to best employ that option position. Here's the trick. With these positions, we want to establish the same profit window, but structure the position such that if your short position expires out of the money and profitable, should the stock or market fall anywhere within the profit window at or sometime before the next option expiration date. That is, since the credit spread has a larger short position than long position, it places a credit in your account as opposed to a debit as seen earlier. This means that in the case here, in this simulated chart graphic, we would be shorting puts at or below the lower edge of the profit window, such that should the market stall anywhere within the profit window at expiration, the short position would be worthless and you keep the credit. The key here is the use of direction plus the income credit derived from the put sales. So we want the market trend to continue while we keep the premium we sold to the traders who think the market or stock will fall. This is a great long-term income strategy that has been used to create massive wealth, and one that I have used to generate consistent income month after month, the advantage being consistent monthly compoundable profit. It is important to remember that risk is inverted with credit spreads. Your losses will be larger than your winners. That is why structuring the most conservative profit window within reason is very important. Let's examine how this will actually work. You'll see how powerful this strategy really is. It puts money in your pocket immediately and allows you to benefit from the greatest number of random outcomes. Here we see an EMA fan continuation setup in Apple Computer around $580. With our initial risk analysis, we have a stop price a few pennies below point B, which is about $550 per share. So what we're going to do is sell a specific number of 550 puts, let's say 5, and simultaneously buy the same number, in this case 5, of 540 puts or 530 puts. We may even want to check out the 520s. The difference between the money we make on the sale of the 550s minus the cost of the 540s or 530s is the credit part of the credit spread. And it is the amount we'll keep if Apple Computer closes anywhere over 550 at expiration. What's cool is that if Apple really takes off like it did, we can cash out early as long as we can get at least 70 to 80% of the premium initially sold. Let's check out another example. In this case, we have a short continuation setup in United Technologies. With the setup triggering around $50 per share short, we want to sell the 55 calls since our maximum risk stop is at either 52 or 54. This is a great situation, as you can see, since the short position is above the suggested stops for the trade. And as long as UTX closes anywhere in the profit window, the credit will be ours to keep. Done properly, the credit spread can be a phenomenal long-term income strategy, because what is most likely to happen is that the stock or market will end up somewhere in the profit window at or sometime before the next option expiration date, enabling you to take full or partial profit and move on to the next trade. Let's take a look at the credit spread management strategy that I use to trade these positions. Remove any spreads if your maximum risk stop is exceeded. If you are close enough to expiration, this can occasionally be done for a profit. This will keep your losses really small, and in many cases there will have been enough time or theta decay to further reduce the adverse effect of the stop. Next, unless you need the margin requirement for another position or you find another setup for the current month or next month's expiration, allow out-of-the-money OTM spreads to expire worthless. This tactic will eliminate considerable commission expense over the long term. Also, sell additional spreads on subsequent tests of the 50 and or 100 EMA pursuant to the rules of the EMA fan bounce strategy. In case this happens, this is an additional method for increasing the size of your position. Let's check out some of the tips and tricks I mentioned at the beginning of the video. One cool thing you can do is finance direction with credit. That is, use the proceeds from your credit spread positions to purchase call or put leaps to trade continuation and bounce setups for leveraged direction. Also, as briefly discussed earlier in some of the examples, legging into your spread positions is another good method. Many brokers have restrictions, and with theoretically unlimited risk, you don't want to do this with credit spreads. But legging into covered calls and puts and debit spreads is definitely worth checking out. In some cases, if your position has moved far enough into profit territory, and depending on what position it is, you may wish to roll the position over to a new expiration month, as long as the fan is in effect. I like to do this with long calls and momentum stocks, especially if the 100 and 200 averages have moved up well over my entry price. If I wish to remain in the trend, thinking it may continue or consolidate and then continue, I'll take the profit on the initial leap contract and replace it with a cheaper leap further out in expiration time that has some additional leverage. The next thing you want to consider is the concept of knowing the market you are trading. I prefer to separate the index listed type stocks from extremely high momentum darling stocks. With momentum, I really prefer to trade direction because these stocks can double or even triple in the right markets. So I want to take advantage of that with long calls only. As for income, I'll typically use index components for the spread positions because they are more liquid and the option premiums can be better manipulated for those strategies. And finally, remembering that the game with direction and options is totally opportunistic. Maintaining good watch lists and structuring your positions around key strike prices and even watching for setups which have close proximity to lucrative strike prices, especially for spreads and income, is crucial and necessary for long-term success. After you learn consistency, these skills will be acquired and your trade positions will become second nature. Let's go back and look at some previous examples of this newfound knowledge and how to integrate options into the system signals. With the Boeing long, we first established the profit window. Now we might see how we could 1. Purchase an outright long call option using a leap. 2. Place a covered call position for income by purchasing the shares and selling a commensurate amount of near-month calls short. 3. Use a debit spread to purchase leaps instead of stock shares and selling the proper ratio of short calls, this being a leveraged alternative to the covered call strategy. And 4. Finally, we have an option to use a credit spread position near the $70 area, which will generate income which can be kept as long as Boeing closes anywhere in the profit window at the next expiration date. Here is another example. Always establish the profit window first, then determine which strategy best suits the position given the type of stock or market you are trading, as well as how the option chain stacks up in terms of the profitability of the contracts and where the strikes are located. We can see the same thing here, first establishing the profit window, then looking at position alternatives. And finally, here, where my best alternative would have been a long call position given the strength and momentum characteristics of the stock, as well as the very low intrinsic risk presented by the setup itself. You may wish to review this material as often as possible should anything be unclear. The key here, as always, is finessing the profit window. But you may be thinking about all the different ways to take advantage of this knowledge and how to find the proper stocks and markets to trade. Well, coming up in the next installment, we'll be looking at just that, scanning the market and assembling watch lists to keep our opportunities in line. So when you're ready to proceed, I'll see you there. Welcome to Elite Trend Trader video number 8. I'm Frank Bunn. In this segment, we'll be focused on 2 very important aspects of scanning the market. These would be the use of advanced charting tools to reduce analytical burden and locate opportunities faster, and compiling watch lists. Watch lists and scanning are the heartbeat of stock setup trading because if you do these 2 things efficiently, you will be able to optimize your time and maximize the number of opportunities you have to compound profit and build wealth. So let's take a look at how we'll be covering all this in this installment. First, we'll be discussing the eSignal EFS scripts you have been seeing throughout the training on the charts. There are scripts for both the EMA fan continuation and bounce setup strategies. Next, we'll be looking at how to implement these scripts on your trading desktop for quick installation and use. And finally, I'll show you how I compile my watch lists for a variety of stock types depending on what directional or market neutral strategy I want to use. Let's begin with the EMA fan continuation EFS. In eSignal, EFS means eSignal formula script. As you've seen in the chart examples for this pattern, bright green colored bars signify the EMA fan uptrend. The amber colored bars suggest a price reaction with the 50, 100, and 200 period EMA portion of the fan intact. Next, the red colored bars denote an EMA fan downtrend. And finally, gray bars signify a trendless environment, which is simply any other price configuration than an up or down fan or correction period as suggested by the amber bars. This is rather straightforward. The procedure for analysis is also straightforward and will save you lots of time. For a long situation, you want to target a series of green bars that evolves after a red or gray period. This is the evolution of the EMA fan uptrend after a downtrend or consolidation. This is the impulse portion of the trend flow analysis. Next, we wait for an amber period to form. This furnishes the reaction necessary to set up a continuation. During this period, we would want to see firm support on the 50, 100, or 200 moving averages in the correction as we saw in recent examples. And finally, when a period of green bars evolves after the correction period, the script is signaling a continuation, at which point we could perform the requisite analysis and begin the procedure for setting up the trade. Let's take a look at the EMA fan bounce EFS logic. We see a green bar evolve when there exists the proper price action long signal, which also has the proper test of the 50, 100, or 200 EMA. There is also a script which signals tests of the 18 period EMA for more aggressive traders. Conversely, a red interval bar signals a possible short entry with the exact inverse logic of the long setup. Keep in mind that the script is programmed to perform the proper price action analysis for the reversal bar, so that it is not only reversing off the previous low or high, but it also has the proper long-term EMA testing. The procedure for using this script is even easier because red or green interval bars are more or less ready-to-go signals. So you'll want to monitor all of the stocks or markets in your watch list. Then, at the evolution of a red or green bar, simply perform the requisite risk analysis as well as filter analysis techniques provided in the low-risk setup video segment. For those of you unfamiliar with eSignal, I'm including the specific procedure for uploading the EFS script to your desktop and the eSignal program. This is a fairly straightforward procedure, and some documentation is available as well on the eSignal website. However, this should get you up and running. You may wish to pause this video should you wish to do this now or return at a later time. Now we can move on to the all-important task of watch lists. Watch lists are key because they not only facilitate quicker trade turnover and efficiency, but over the years I have found that different equities perform better with certain directional and market-neutral strategies. Let's begin with the quality momentum scan I rely on consistently. I use the Investors Business Daily 85-85 list almost exclusively to locate my high-quality momentum trades. This list is basically all of the stocks in the Investors Business Daily database that have an earnings rank of 85 or greater and also a relative strength rank of 85 or greater. What this means is that these stocks on a price, momentum, and earnings basis are or have been outperforming 85% of all other stocks during the last 52-week period. So these are candidates with strong fundamentals and exceptional price momentum. I sort these by average daily volume and exclude stocks with less than 100 share average daily volumes. The key here is that you can also compile a list of these stocks that have option chains. According to the Investors Business Daily, the 85-85 list has outperformed the S&P 500 index during the last 13 years by more than 10 to 1. So these stocks are small and mid-cap movers you're looking for to trade direction effectively. So I'll generally use this list for long calls. The next scan I do is for momentum. also suitable for trading long calls or shares if options aren't available. It is my quality momentum scan number 2. Here I search the Investors Business Daily or the StockTables.com database for stocks with a relative strength of 90 or greater, with a price of $15 per share or greater, and which also have an average daily volume of 250,000 shares at least. Additionally, here I look for stocks which have doubled in the last 52 weeks to ensure that I have only the serious movers in the watch list. Many of these stocks will triple, quadruple, or even more on their way past the doubling point, so long calls are great for these candidates as well. The next scan I perform is a speculative momentum scan. Here I narrow the scan to only those stocks with a 99 relative strength, so I'm looking for those equities which are making the sharpest, quickest gain. I'll also restrict this list of stocks to those with less than $15 per share, but still have decent daily volume. Again, using the doubler filter, only those which have doubled in the last 52-week period ensures that I'm focused on the all-out movers. It has been this list which has consistently given me my largest percent gainers over the years. Most of my trades which have doubled and occasionally tripled in price after I entered came from this very scan. The key here is pure direction. Since options are not typically available for these stocks, I almost always trade the shares. Once you have the momentum list compiled, you'll want to focus on maintaining a list of very liquid, index-type securities for setups which will employ covered writes and spreads. To do this, you'll want to compile first the Dow Jones Industrial Index of 30 stocks, followed by the NASDAQ 100 Index, which are the top 100 non-financial stocks on the NASDAQ Stock Exchange, as well as the S&P 100 Index. You'll want to eliminate the duplicates when you sort them, as many of the NASDAQ stocks are also in the S&P 100 Index. This is my go-to list for moving with the market timing model and generating monthly income with the options. Whereas these are low beta stocks typically, meaning they will usually perform about as well as the broad market in terms of volatility, I generally don't trade these for direction unless it is short during an EMA fan downtrend on the broad market. Since these stocks are large cap securities with liquid option chains, they make great candidates for spreads, leaving my high momentum lists as the primary tool to benefit from directional trading. This has been an overview of how I compile my watch list and the tricks I've learned over the years to maximize my effort. Take some time to ensure your watch lists are updated and ready to go. You'll miss less opportunities and your trading game will be more effective. See you in the next video. Welcome to Elite Trend Trader, segment number 9, Day Trading and Forex. I'm Frank Bunn. In this video, we will be briefly covering how to use the specific strategies you've learned to day trade or short-term trade various markets using much shorter chart intervals. We're going to begin with making a few key points about the differences found in trading short-term intervals, as well as different types of markets, and then proceed to plenty of examples so you can get the best idea about how to benefit from short-term price movement. Conceptually, the EMA fan continuation and bounce setup patterns replicate on any interval. The only real difference is found in the market dynamics which facilitate or prevent effective entry and exit. The key, however, is risk management and the time crunch associated with shorter day trading intervals. Risk management is also trickier in the Forex markets, where the pip leverage often results in much higher initial risk given the same elite trend trader setup types. More on this in just a minute. Let's cover day trading first. Here's a hit list of the strategies to shorten your learning curve. First, focus on EMA fan bounce entries, since risk can be determined much more quickly and intrinsic risk is generally smaller given the size of the price bar. Next, in the U.S. markets, trade first hour reactions only to begin from 9:30 to 10:30 a.m. After you achieve consistency, begin to trade last hour reactions from 3 to 4 p.m. Use scripts like those included with this book to complete as much of the analysis as possible and speed your analysis to action time. I also use scripts which automatically calculate risk, determine targets, and size positions as well. This creates a tremendous advantage over other screen traders competing for the same trends. Trade expensive, listed index securities, Dow Jones Industrial Average and S&P 100 type components, with very close bid-to-ask spreads. This may seem obvious, but most day traders end their careers shortly after chasing markets in which it is nearly impossible to adequately control short-term risk. I recently completed a 3-year extensive day trading project, and most of my empirical data suggests that using the 3-minute, 5-minute, and 10-minute intervals for North American securities is the most effective way to profit from EMA fan strategies. Finally, remember that volatility is relative. 10 or 20 cents in a low beta stock is typically easier to profit from with leveraged positions than a high beta NASDAQ stock with a huge range and spread. On most platforms, stop orders are triggered by bid and ask quotes. This makes bogus entries more likely on intraday trades. Use contingency orders to create pseudo stops. It is beyond the scope of this course to adequately cover advanced trade management techniques, but in my coaching courses I teach advanced tape reading and day trade management tactics. The short term requires that your trade management plan be focused and quick, given the speed of short-term price movement. You have to be sharper and faster than the next trader. But this will definitely get you started. Let's look at a few examples of what you want to be trading, especially at the opening range. In any day trade interval, 3, 5, or 10 minute, if you focus on the opening range setups, those patterns which evolve after the open but within the first 30 to 60 minutes of trading, you can really get consistent. In my experience, count on being busy 10 to 12 days out of the month when correlated large cap stocks are trending significantly up or down. It is okay that you don't trade every single day. You can still get consistent and generate exceptional monthly and quarterly profit from the first and last hour moves. And you won't be over trading or attempting to set up trades at less probable times during the day. In this example, we have an opening range breakout trade in United Health on the 5-minute chart. I can watch 50 to 100 of these in my standard day trade layout, and I have EFS scripts established to locate the lowest setup risk entries. The key here is trade management on the tape read. If the stock makes a new day high, I shed a partial position and move my stop on remaining shares to break even. Then I watch for new highs and reactions that don't change the trend, allowing no more than a 1 to 2 bar pullback. Remember, you're dealing with the EMA fan here, so the stock will already be in a rock-solid up or down trend. Here you can see how I would have moved stops up a few pennies below the dotted red lines as the stock advances. In this example in National Oil Well Varco, we have a very low intrinsic risk reversal off the 50-period EMA. You should notice that the double hit on the 50 moving average greatly reduces your intrinsic risk in the pattern, after which the market rockets to a new day high. The key here is that these types of setups you can actually achieve 2 to 3 times your initial risk or more. You'll learn over time that this is the real secret to trading success. Having a high win rate is one thing, but being able to set up trades that have low initial risk, then allowing the trend to take your profits to 3 or 4 or even more times that risk and profit is what will make the greatest difference in your success and catapult you past all the other scalpers out there who take a few pennies in profit on each trade and struggle to stay profitable with equal size or even larger losses. In this next example in Caterpillar, we have a low-risk downtrend setup on the 3-minute interval in the first half hour. Notice the double hit on the 100-period EMA in the pattern. You have to know this is probably going to react down. I also know that with the confirmation on the 100 EMA, that if price retraces to that level again, it will most likely hold, and it does. Although I usually take partial profits or shed a percentage of the position during the initial follow-through, I never forget that this is day trading. I'm in it to win it and pull money out of each trade when the market shows me profit. But I also want to never forget that I am dealing with the EMA fan here, and that if I let the trend do the work, I always have the potential for a big runner in any direction. So the key here is to shed risk and manage the trade with the tape read. Here I'm able to move stops a few pennies over the highs at the dotted red lines as the stock progresses lower. One of the key things I look for is a new day high if I'm long or a new day low if I'm short. I want these highs and lows to evolve after my trend entry as quickly as possible. This tells me that the trend is strong and likely to continue, and it allows me to sit. I am careful and cautious with stocks that do not make new highs after the setup pattern appears. This is indicative of consolidations. In this example of a long in UPS, I have a really firm support on the 18 and 50 period moving averages, but notice that the follow-through to the new high never evolves. The stock consolidates for the rest of the day on this 15-minute interval. I can still move stops under the reaction points or call it quits and take profit on whatever I have going into the noon hour when the markets tend to get quiet. But the key here, as you're learning, is the first hour. The first reactions during or after the opening range, as well as the subsequent breakouts, are the most probable and the easiest to spot, and the ones most likely to be consistently profitable. Trust me, just work an hour a day and you'll be amazed at the results. Let's continue the training by looking at the Forex markets. Although pip risk is considerably higher, I will not trade any interval shorter than the 24-hour chart. There are several reasons for this, including probability and also being able to realistically manage the trades overnight from here in the U.S. I have worked with traders and even once coached a student from New Jersey who traded short intervals from the 15-minute chart up to the 1 and 4 hours. And as a consequence, he frequently traded overnight through the Asian and European opens. That's not my style, but in this game it is whatever works for you. That said, here's an example of a recent trade in the Euro-US dollar spread. Although the Forex pairs do not exhibit the EMA fan pattern all the time, when they do, the reversals are incredibly probable and profitable. Here's a short example in the same pair. You can see the double hit on the 50-period EMA, which results in a really low intrinsic risk setup at that time. Notice the additional signals as well as denoted by the subsequent red bars. This evolved an absolutely massive downtrend. Just a few of these a year can make an incredible difference, and the leverage is unbelievable. Let's take a look at this next one. Here we see a total of 3 entries, with the first one being a loss. The key here is the EMA fan rule of thumb. See how that although the 50-period EMA stalls the price, the setup just doesn't hold. However, the 100-period EMA offers 2 great low-risk setups. You should also be able to see how you can control your risk, and that the winners are much, much larger than the initial risk taken on the reversal bar bounce entries, according to the system. Speaking of a large potential reward to risk skew, here's another example. These types of low-risk EMA fan bounce setups are my favorite ways to trade Forex markets. Small initial risk and big winners, the secret to trading success. I will occasionally use the continuation setups with Forex. However, I must be certain that my initial risk is low enough to merit a potential 3 to 5 times that risk in reward or potential profit. I always want to establish the setup such that if I really hit a winner, I can gain 4 or 5 times risk or more. In this example, the British pound Japanese yen pair offers a reasonably low risk entry with a close pivot stop overhead. Given the recent volatility at the time, I figured that 400 or 500 pips was possible if the trend continued down. We'll conclude with another example here in the Euro-Yen pair. In this example, we have a continuation entry over 118. Notice the firm support on the 200 and 100 period EMAs during the correction. This demonstrates the awesome power of the trend. Just remember, with day trading you want to focus on the first hour. Keep your watch list manageable and get consistent with the lowest risk, highest probability entries that evolve at the open. The Forex market will allow you to focus on the strongest trends in the major pairs with the tight spreads. And all things being equal, short-term trading in the Forex markets don't chart any differently than anything else. The difference lies in the markets themselves. As you develop your own style, you might find a place for these 2 powerful tools in your trading arsenal. See you in the next segment. Hi, and welcome to Elite Trend Trader installment number 10. I'm Frank Bunn. In this video, we're going to look at a very specific pattern that I've noticed over many years of studying small and mid-cap equities. I call this the anatomy of a doubler. There's more detailed explanation of the concept in the accompanying ebook, but the general idea is that certain equities exhibit technical and fundamental characteristics that inherently establish the potential for massive price appreciation. This footprint can be coupled with the power of EMA fan setup patterns. The idea here is that certain types of equities exhibit technical and fundamental characteristics such that significant price appreciation is not only possible, but very, very probable. And according to Don Trump, you have to think anyway, so why not think big? So what we're looking at here are the most common criteria found in stocks which double in price. And we couple this fundamental criteria with the power of the elite trend trader setup. So let's examine these fundamentals. First, we have the recent IPO or initial public offering. Typically within the last 3 years, so these are newly listed companies with tons of potential, your Facebooks, Twitters, Googles. Next, the price of the stock must have doubled in the last 52 weeks. This is counterintuitive. Many traders would think that because the stock has made such a huge run that the trend is over. However, my research has concluded that many growth stocks will pass through the doubling point on their way to tripling, quadrupling, or even more. In some cases, they go up tenfold. The next criteria is low float. We want to have stocks with very low floats, meaning there is a limited number of shares available for public trade. The float, as compared to total shares outstanding, is the number of shares available for trade that are not restricted. Think of it like this. If there are only 2 houses for sale in a very popular neighborhood near the beach, in a sunny location where everybody wants to move in, what happens to the price? You got it. Prices rise dramatically. With low float stocks, the buyers will have to go to the sellers, as the latter will be few given the big run-up in price. No one wants to sell a stock that is going up after all. As a result, demand will inherently lead to more price markup, a simple recipe for higher and higher prices. After this, we look at debt. The companies in question generally have no debt on the books. They are very well-managed companies with good cash flow. After this, and most importantly, the companies themselves are engaged in businesses in cutting-edge industries. Technology, biotechnology, must-have products, etc. This positions the company and the stock for merger prospects and the possibility of huge earnings potential. And finally, the chart pattern will evolve an EMA fan continuation, a natural evolution after the stock passes through the doubling point and generally corrects in a base consolidation. All this good stuff culminates in a perfect storm scenario, so let's look at some examples. Here we have Qihoo, a Chinese internet services provider. Notice the above referenced criteria in addition to the EMA fan continuation pattern in the chart. The price doubled in 68 trading days. This example is in LinkedIn, the professional social networking site, also a low float, no debt recent IPO in the internet industry. It just demonstrates the awesome power of the EMA fan in combination with these fundamental criteria. Why trade boring Dow stocks or invest in sluggish mutual funds tied to the low beta broad market when you can set up a trade with this type of incredible potential? 85 points in 90 trading days, almost a point per day on average. That is momentum. Here is Zillow. You should be starting to see the pattern by now. Another internet software and services company. Massive price appreciation in 59 trading days. And the cool thing is that it doesn't really matter if they double or not. The moves can result in several dozen R, meaning the profit can be 20 times your initial amount risked. This is how you build wealth. So much of trend trading is all about what you trade. It is one thing to understand trend dynamics, but price momentum and holding positions in the fastest moving stocks is the hallmark of cutting-edge techno-fundamental trading and investing. Using the scans you learned in recent training segments will put you in front of these types of stocks, and you can start thinking big. Is there any other way, really? See you in the next video. Hello, and welcome to Elite Trend Trader segment number 11. I'm Frank Bunn. In this video, we'll begin to wrap up the training with some key elements in what I call pulling the trigger. There is definitely a perspective requisite to achieving long-term success when it comes to trading, because so much of the game involves dealing with unknown random outcomes. You want to place your focus only on the things you can absolutely control, and release attachments to outcomes, hope, and dreams. How do you do this? Well, the best way is to always focus on the setup and never focus on the result. Setup focus is the way to consistently use all of the tools you've acquired in the training to target the lowest risk, highest probability setups, and then begin to build 20 to 25 trade samples of these and examine your performance over the whole sample once completed. You'll learn that any one trade or outcome just doesn't matter, but rather your collective effort is what wins the game and allows you to stay on track day in and day out. Next, we're going to look at a simple trade matrix introducing the type of mental attitude and focus necessary for optimal success. Then we'll examine a really cool way to compound your profit and maximize your leverage while still controlling risk. And then complete the segment by looking at the EMA fan success equations and why this strategy continues to work over and over again. Let's briefly discuss the matrix I just mentioned. We'll consider the old wash, rinse, repeat sequence. What we want to always be doing is 1. Focus on the EMA fan, the highest probability trend continuation pattern, which leads to 2. Mastering the intuitive mechanical approach to finding the lowest risk, highest probability entry setups, which leads to 3. Selecting the best position for the entry, which allows us to sell time and profit when the market moves in the proper direction, goes sideways, or moves adversely a few percentage points. And we can do the same thing if and when we are directional trading, focusing on the lowest risk, highest probability setup patterns pursuant to the fundamental types of risk, always looking for entries with a very small amount of fixed risk, and theoretically unlimited reward potential, given that the EMA fan can randomly continue in the direction of the primary trend for a considerable period of time. With this perspective firmly in mind, let's learn a really neat trick for compounding profit. This is really great to do with options, but can also be done with your directional positions as well. Number 1, regardless of account size, divide the account 6 to 8 ways equally. Then, in a spreadsheet, establish each equal amount as a sub-account within the main account. And then, begin to place positions, either debit spreads or covered call positions, with amounts that equal each initial sub-account. Finally, at expiration, recalculate position sizes. Winning sub-accounts will be larger. After this, you want to use the larger amounts in step 4 for new positions, following which you simply repeat steps 1 to 5 after each expiration. And here's where you begin to compound your profits. This can be done with directional trading as well, using the new recalculated sub-accounts to compound your new directional trades. This is a great way to stay as fully invested as you can without having to plunge the entire account into one position. It will also keep you focused on growth and moving forward. Let's move on and discuss the EMA fan success equations. This is really the key to this entire strategy. The two things that separate this type of trading from everything else out there. First, delta neutral option positions plus probable market direction equal the maximum chance for success. This is so crucial, and by now you should understand how the risk window with the options positions gives you the greatest shot at closing the transaction profitably within the framework of the underlying asset trend. And it's such a very, very powerful concept. Next, leveraged directional positions plus low-risk continuation entries equal controlled risk and unlimited profit potential. This is the heartbeat of the system. So many strategies out there, including scalping and many option spread strategies, have what is called inverted risk skew, whereby the trade risk is equal to or larger than the potential reward. This is a common occurrence in credit spreads and the primary reason so few traders can consistently profit from them. One of the greatest lessons I ever learned was how to set up trades that have limited controlled risk and theoretically unlimited reward. And now you know how to do it too, and that's very exciting. Learn how to compound profit and integrate the wash, rinse, repeat strategy to make your trading focused and consistent. And I'll see you in the next video for the conclusion to the training. Hi, and welcome to the conclusion of Elite Trend Trader. In this, the final segment, we're going to review the key concepts which will guarantee your long-term success in the trading business. Let's begin with a recap of the training highlights so you can organize and integrate these key concepts. First, we learned the rule of randomness. Now you firmly understand that the outcome of any technical trigger, including the Elite Trend Trader logic, is random. And we don't fight that randomness, we manage it. Next, we learned the truth of the trend. Within the framework of randomness, we have empirical evidence which suggests that a trend once begun is statistically more likely to continue from one interval to the next than reverse. Following this, we introduced the exponential moving average fan, which is the critical technical evolution that defines the system. It inherently establishes momentum and places your entries consistently in the strongest trends. Consistently trading the EMA fan, the continuation and reversals which develop therein will increase your performance exponentially. Next, we covered the two-bar reversal pattern as the key low-risk recurring entry setup pattern that functions the best with the EMA fan evolution. This pattern can be intuitively analyzed to consistently discern the lowest risk, highest probability setups within the framework of the three different types of risk. Along the lines of low setup, intuitive, and contextual risk, we learned how to analyze and spot randomly recurring low-risk entries that have additional technical characteristics which empirically make them more probable. The power of this knowledge and intuitive control cannot be overstated. As a natural evolution to mastering the trend flow analysis and the EMA fan continuation and reverse logic, in order to fulfill the EMA fan success equations, we learned the best types of options positions to trade with the system. Not only to take advantage of directional trading, but more importantly, to use directional probability to be more certain about generating consistent monthly income by selling time in the form of options premiums. And pursuant to this end, establishing the options target window enables the trader to profit from trade positions by encompassing the greatest possible number of random outcomes. Combining the merits of trend trading with delta-neutral strategies lends itself to large profit windows where option spread positions can be profitable within relatively large fluctuations in price. Finally, we covered the EMA fan success equations, which encapsulate the entire strategy into two key concepts. These success equations pertain to delta-neutral positions as well as directional trading. First, the trader has the greatest likelihood of success by combining delta-neutral options positions with probable market directional setups. And second, leveraged directional positions can be established such that risk is controlled to 1R or 1 times risk, and potential reward or profit may be theoretically unlimited, whereby the trader can randomly take advantage of the large gains made available to him or her by the market in the form of massive trend continuations. And so remember, the truth of the trend plus a low-risk entry and a market-neutral position will give you the greatest and easiest chance of consistent success, so ending the frustration cycle and fruitless search to somehow control randomness, which can never ever happen anyway. And so, as I promised in the beginning of this training, you now have all the tools necessary to consistently profit in any market. Indeed, this is the only comprehensive method and complete trading solution you will ever need to spot the lowest risk, highest probability entries regardless of whether the market goes up or down. And it provides all the tools necessary to generate capital appreciation and trading profits in up and down markets, as well as produce consistent income in sideways and in any trending market as well. In conclusion, having this knowledge isn't enough. Knowledge, they say, is power, but I disagree. I believe that application is power. Mastering the principles you have learned and testing, applying, and integrating the strategies such that you develop your own style given your goals and aspirations for your own trading business is what will ultimately make the difference. Your willingness to learn, accept the right type of risk, and release attachment to random outcomes is the ultimate ideal trade flow state, and I know you can do it. Over at Stock Market Equalizer, the gang and I have established a fantastic coaching program which can take your trading to the next level. Based on over 2 decades of trading experience in just about any market imaginable, with loads of empirical data and research that support the mechanical intuitive approach as the best way to achieve lifelong profitability. We offer all kinds of training on everything from pattern recognition to system development, options, as well as strategic trade and portfolio management. So definitely check it out. We continue our research and development on a daily basis and have really assembled a great team of traders and developers, sincere mentors who can help you up your game, no doubt. I just can't overstate my gratitude for having you along on this ride, which promises to be a life-changing, profitable journey for you. I really do appreciate your willingness to take the leap, break out of comfortable patterns, and challenge yourself. I thoroughly enjoy hearing from traders all over the world who have integrated these principles and started making serious trading profit. By all means, get in touch. Send an email, anything, comments, questions, complaints, success stories, and any challenge you may confront. I look forward to hearing from you. And on behalf of the whole gang here at Elite Trend Trader, I thank you again and wish you a stress-free, wildly profitable trading career. To your success. Have a great day.